Hi everyone, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. 2 weeks ago, I said that the FANGs in general, save for one, were giving me the heebie-jeebies, and I think correctly so. Only one of the FANGs looks to be what I might call a safe and near-term investment, while 6 of the 7 have either provided outright sell signals or on the cusp of doing so. However, as we will see today, it's an ill wind that does not blow some good, and the FANGs may be on the cusp of providing investors with an entirely different investing experience. Anyway, before we take a close look at the FANGs, I do want to say thanks again to everyone who likes this video and all our subscribers. Okay, last week I reminded people of a webinar with you a few months ago in which I showed you what Coca-Cola looked like when it made its big market top and correction from its HB5, and that's a familiar number to many of you, here at 26 times book value, all the way down 6 years later, 1998 to 2004, all the way down to its mid-super growth price. That's 5.5 times book. 26 times book to 5.5 times book. That's a long way down. Well, Coca-Cola didn't get there by a sharp plunge. It fundamentally did what we call walked downstairs. And look what happened. Okay, the stock dropped from its HB5, 2 breakpoints, rallied 1, down 2, rallied 1, down 1, well, then down 2, nice rally, and so on, all the way down. And I suspect that something like this is probably going to happen with a number of the FANG stocks, which are fundamentally growth stocks. It's just that they are very expensive. Well, let's go and take a look at the first trading opportunity that we have. Now, I had said that we did not like NVIDIA, but last week I warned you that if this stock got down to its HB3, okay, that's 16 times book value, that it may well provide a nice trading opportunity, and it did. So far, the rebound has been worth about 10% on the upside. Amazon, a work still in progress. I suspect that it's probably going to head down to its HB2, and frankly, I'm prepared to wait for it to get there. Apple, same thing, rendered a nice sell signal. Again, I suspect the HB4, which is 20 times book value, is probably a near-term target. But I think, as you may remember from last week, my target may actually be quite a bit lower than that. Netflix, wow, Netflix is enjoying a nice drop, and it too may get down to its HB3, okay, just the same as NVIDIA did. That's $480, and again, that may give us a nice trade. So bookmark this one and watch it carefully. Facebook, I don't even know what to say about Facebook. It just kind of clings like cloth, doesn't it? Doesn't want to let go, doesn't want to break out and do anything. So I guess I remain a bit of a nervous holder, is about the best I can possibly say here. And Microsoft, by the way, same thing. Broke out 19 straight days of a confirmed buy signal, and then it broke right back down again. Well, I have elected to abandon ship on this stock as of last week, but we'll have to see whether that's a good decision or not. And finally, Alphabet has made a beautiful breakout over its mid-super growth price. That's 5.5 times book value, and that is a 10-year high on the stock. It's not an all-time high, but it's a 10-year high. And that breakout pullback looks good. I like the look of Alphabet. as a long-term investment. Now, in summary, first and foremost, NVIDIA gave us a beautiful buy signal at its HB3 for a trading rebound. Note how quick that buy signal was, however. Bear market buy trades are not like bull market buying opportunities, which can develop slowly. They are sharp and fast, and you have to be ready for them in advance. Anyway, Amazon has failed to hold at HB3, or 16 times book, and rendered a sell. In doing so, that sell was confirmed by Apple, which had plunged sharply as well, also rendering a short-term sell signal. Both signals remain in force. Reviewing Apple in particular, as I said last week, I'm thinking that Tim Cook has started to think about that $112 billion of debt he is carrying versus the $66 billion in equity on his balance sheet, and may have decided that enough was enough. If this is a correct assessment, then, as I showed you 2 weeks ago, Apple could easily lose up to half of its current market value. This week, Facebook wobbled back up through resistance at the mid-super growth price. It's 5.5 times book. Although today, it's let go again. As you are aware, I've held this stock nervously for some time, and the evidence shows that the market is as nervous about the shares as I am. I had welcomed Microsoft into our Phantom portfolio, although, as I said at the time, I'm not a true believer. This week, like Facebook, the stock failed to hold at its HB2 price. That's 12 times book. And if Microsoft follows the lead of Amazon and Apple, it could easily head lower. I said that I would sell my holdings at this juncture, as I do not care to find out what will happen with this break. Like that of Amazon and Apple, if it's for real, I don't want to be there. And so far, the jury is out on that decision. Netflix is in a nice downtrend, but could well emulate NVIDIA and provide a nice rebound at its own HB3 price. So bookmark this stock for such an event. The one bright spot among the FANGs remains Alphabet. Alphabet, which had broken out nicely over its MSG price, 5.5 times book, is holding nicely, and I suspect it counts much higher. Now, similar to last week, my first takeaway this week is that the S&P 500 continues to hold in just above its super growth price. That's 3.5 times adjusted book value. Small wonder that it's struggling here, of course, because the values are so generally indifferent to poor. What we see recently that is of considerable interest to me, however, is that the NASDAQ 100 has actually suffered a setback from close to its HB1 price, that's 10 times book value, down almost but not quite to its bubble price, that's 7.4 times adjusted book. It missed that target by only about 3% on Monday before that strong rebound on Tuesday. But there does not seem to be any follow-through, at least so far. In other words, the high-techs are not particularly participating in the recent market strength, insofar as we can describe recent market events as strength. In my experience with the U.S. market, regardless of what happens with one or the other of the S&P and the NASDAQ 100, we only get an overall market sell signal if they confirm each other. So first, the S&P had better hold in just about right here. And second, the NASDAQ had better find its footing as well. I do keep wondering what the overall effect of that $1.9 trillion of stimulus spending will be on the market sometime in the next month or two. And I, for one, am unprepared to try to outguess what the stock and the bond market outcome of that will be. Second, as this week has underlined, The FANGs are clearly not the leaders they once were, and worse, maybe trying to lead on the downside, as I think you have all clearly seen. I observed last week that when growth stocks implode, they do so gradually and over time, and usually offer terrific short-term trading opportunities on their way down. On the long side for most of you, but on the short side for those of you who like that kind of trading. Today, I reminded you of what happened to Coca-Cola after its bust in 1998-2000 through 2003. And the trades that Coke offered on the way down were big and fast and beautiful. Again, I suggest that you find that webcast and keep it close to your heart. I suspect that the trading opportunity in NVIDIA this week was the start of a litany of such trading opportunities in the FANGs in the years ahead. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next Friday. Until then, stay safe. This pandemic is not yet over.